Harrison Bonner here from the Wollaston Wealth Management Fund. Today, we are going to be walking through our financial model for just the seed round of investment capital in our fund, the Wollaston Wealth Management Fund. So the purpose of this pro forma or this financial model is to demonstrate essentially how the cash flows will flow from the fund level, so from the time the fund investors invest, um, how that capital will then flow into the individual assets, how those assets and where it will be deployed within those assets, and how it'll be utilized. And then next, tracking the asset performance during the hold period, as well as capital events. In this case, will be refinances, but a capital event could be a refinance or sale, just something that's bringing significant amount of money back into the fund. And the general performance of the property and the cash flows of that at the property level. It'll summarize it at the fund level, and then upon the exit at the end of the fund, we'll demonstrate how the cash flows will then sort of flow back up to the fund level and to the limited partner investors. So let's get going. As you can see here, we are. I've got this in as one spreadsheet here with multiple different tabs at the bottom. It sort of starts at the highest level. If you just wanted to look at one sheet and you didn't want to dive too deep into the details, if that's your style, then this performance summary is definitely the sheet that gives you the most high level of information. So starting here on the left side, we have our key percentages. Our fund, the Wollaston Wealth Management Fund, has an 8% preferred rate of return to limited partner investors, and then has an 80-20 profit share pool. So any profits above and beyond the first 8% to limited partner investors is then split 80-20, 80% to the limited partners, 20% to the general partner. Now, anything here highlighted in green is going to be relevant to the limited partners specifically, and then any cell that's highlighted in this yellow here is going to be more specific to the fund as a whole. So our seed round is 2 million. So this pro forma is modeling as if we were to stop the capital raise at $2 million. Now, that's certainly not where we intend to stop. Our minimum raise is 5 million, but we will grow the fund organically as we can scale our operations and as it raises capital as we buy additional properties. But this model, for the purposes of this model, this is if we just stopped at the $2 million mark. So the seed capital investors could sort of see how we perform at that mark. Over here, we have our expected internal rates of return and equity multiple. As you can see here, expected a 20% internal rate of return, or IRR, and 2.72 equity multiple. Here also have some assumptions that we can play with should we want to change something and see how that affects the model. But some assumptions for our property value are a 7% cap rate. Now, this is based on some past appraisals that we have received on some other properties in the market and just generally our market knowledge. This is a refinance interest rate of 7%. So any property that has a refinance modeled into it is modeling a 7% interest-only loan. This is sort of kind of middle of the road for the market. Didn't want to get too deep into amortization of paying down a principal. So just for simplicity, we're modeling this at a 7% interest-only loan for any property that has a refinance event. And then with that, it's estimating a 70% loan to value. Now, this is, again, I kind of try to stick down the middle of the road with these assumptions, but these can be played with to see how it would affect cash flows and equity and things like that. All right, so let's get into the years. We have year 1, 2, 3, and 4 as we go across here. And we start here with our capital account balance. So this is the capital account balance of all of the limited partners combined. This next row here is our total portfolio cash flows for the year. And this is summarized here, this portfolio on this portfolio tab, which is a summary of the individual properties. So let me go back to the top. Okay. So we have annual cash flows. We have fund expenses. Year one has some additional startup expenses, which is why we're estimating year one to have a higher expense number. But this is, tax prep, marketing, miscellaneous expenses that would be covered by the fund. And then we have our 2% asset management fee right here. So this is paid out each year, which is just 2% of the total capital invested. All right. So here we have our annual fund profit, which is just cash flows minus fund expenses. And then here we get into the first distribution to the limited partners. Now, if we do not hit the 8% preferred rate of return, which 8% of 2 million would be 160,000, then all of the profit goes to the limited partner investors. So as you can see, we're not hitting that 160,000. Now that will be made up at a later date. You don't just it doesn't just not get paid, but we're not able to hit it in year one as expected because year one is a heavy value add and development year. So we'd expect cash flows to be lower in year one opposed to years two and so on as developments sort of mature and the properties begin to cash flow a bit more as we'd expect. So there's no profit share because we don't hit our our minimum preferred rate of return for year one. And we do have a small liquidity event, which is a refinance of a property in year one. And any capital event, such as these refinances, these could be used for a couple different things. So 20,000 here isn't too much for year one. But for year two, we do have a couple more that are a little bit more significant. Now, I'm just modeling this as cash on hand, so additional just reserves to have. Now, this could be used to return initial capital to investors. Now, that would decrease the preferred rate of return. If let's just say this was $1 million. If you get $1 million of initial capital returned, then the preferred rate of return is going to go down because the capital account balance is now $1 million instead of $2 million. So your preferred rate of return would be 80,000. So again, for simplicity, I'm keeping it as cash on hand, but this could also be used to expand the portfolio. We could go buy another project if that's what we wanted to do with this and grow the portfolio. But for simplicity's sake, to just show the performance of these properties that we already have this $2 million earmarked for, I'm just keeping this as cash on hand. So this is going to be the most conservative way to deal with this extra cash. All right. So as you can see, the profit share, the cash flows, fund profit, all continuously grow through the years. And this is that profit share pool. So the 80% of above and beyond the 8% to limited partners and 20% to the general partner. Here we have a table of property values. So again, this is estimating a 7% cap rate across the portfolio, total property value, first liens associated with those, total equity in those properties, and then that equity split 80-20. Just so you can see kind of how the portfolio is growing over time and how your percentage of the equity as a limited partner is growing over time as well. Now to the exit. We have our property sales here. So at the end of year 5, if we've done everything right, we've got a property value just shy of $12 million minus some broker and selling expenses. We would have a gross to seller of just over $11 million. As we have mentioned, there's a number of different ways we would expect, we're A number of different exit strategies that we could pursue depending on what is most advantageous at the time. But either way, it would record at at fund one level, it would be effectively a sale of the portfolio or of the properties individually. So we have a gross to seller minus our total first lien payoffs here. So we have our net to seller. And then from this 3.6 million in net to seller, we will return initial capital first. So return the 2 million back to the limited partner fund investors. We have that preferred rate catch up. As I mentioned here, we were short in year one for the preferred rate of return. So we're catching that up here to make sure that that first 8% is met. And then we have a total fund profit of 1.5 million. Now we add in our cash on hand. Remember, we're holding now about 1.6 million in cash on hand from refinance events that have occurred during the hold period. So we add these together and we get our total profit share. So this is total cash to be distributed to between the limited partner and general partners. So this is what is split 80-20. So limited partner profit share, general partner profit share. And here we have our table of cash flows. So we have an initial investment, cash flows to limited partners over the years, and then the exit. Obviously, larger windfall at the exit when the properties sell. And that is used to determine our internal rate of return and our equity multiple. All right. So here on this next tab, it dives into sources and uses of this $2 million, the different properties and assets that 2 million would be utilized for. There's some reserves built in here. So we also have CapEx budgets. So if you want to see, okay, on 427 to 435 Maple Street, how is this $300,000 being utilized for acquisitions and renovations? Well, the renovation portion is here in this CapEx budget. All right, so here is kind of like it's kind of like a trailing 12. Now these rows are hidden by month, so not to make this too grand. So you can dive into this as granular as you'd like. As you can see, we're pretty detailed with all of our property level expenses or possible incomes that we could achieve and expenses. Okay, there we go. But I have it summed by the year. So we have today's performance. So you can see how we are generally performing today. And then we have the model performance over the hold period. So years 1 through 5, starting with income, subtracting our vacancy, any other income that we could generate, and then accounting for all of our expenses, property management, real estate taxes, insurance, utilities, trash, repairs and maintenance, all of these things. So to find our net operating incomes by year, accounting for our debt service, and then this is where those cash flow numbers are coming from. They go back to that portfolio summary tab. And then property values, refinances, and the years in which they expect to occur. And then this is all formulated from the individual property pages. So these are tabs for each individual asset and the expected performance and related expenses for those assets. All right. So that is quickly how to follow this pro forma. I hope this guide was helpful. And onward and upward to 20+% IRRs and 2.7 equity multiples. I think we would all be super happy with that. I try to be realistically conservative. I want to be, I do try to be optimistic. But we can play, if our cap rate was 8% instead of 7%, if for whatever reason property values were going down because cap rates were going up, we could see how that would affect us. We could see how, if interest rates went to 10%, how that would affect us. If loan values went down to 60% LTV, how that would affect us. So these are all built in so that we can kind of, I'm shooting down the middle here, trying to play realistically conservative, but optimistic. But have these models built in so that we can see like, well, if this happened, then how would this affect us? Or if this happened, how would this affect us? But I feel pretty confident in these returns. So as we get this $2 million bucket filled up, we're excited to see through this performance over the next 5 years.